Late last week, fears about Silicon Valley Bank led to mass withdrawals, mostly by businesses in California, from the bank on Thursday night into Friday morning. And we're talking tens of billions of dollars worth of withdrawals from the bank. It became a crisis that the Federal Reserve and the FDIC and California regulators had to step in and do something in the middle of the workday on Friday, as opposed to waiting until end of business Friday to shut Silicon Valley Bank. We had two things happen. One, we saw the U.S. government say they would backstop all deposits. That's insured deposits and uninsured deposits with Silicon Valley Bank and Signature Bank. And then also the Federal Reserve opened an emergency window to allow banks to basically pledge any of these bonds that were now in question as collateral. So they could withdraw, they could give these bonds to the Federal Reserve and then take the cash and then give that cash back to their depositors to stop additional bank runs. As the Federal Reserve raised interest rates in the last year and a half to combat inflation, the ability for these startups to get money from investors had become increasingly harder. So that money sitting in that bank account became, instead of just money sitting on the side, became money that these startups actually needed. So they were withdrawing money from Silicon Valley Bank to pay their office expenses, and they were withdrawing even more money. This morning, bank stocks are down quite sharply. We're seeing some sell-offs in like First Republic Bank, Zions Bank, Charles Schwab, which is, I think, a reflection of investors sort of repricing the risk of mid-sized banks. But I don't think it's a sign that investors think that mid-sized banks are going to fail.